of a free cash flow. We are finding computation of weighted average cost of capital. We are finding the first, we are taking the question. See here they given the compulsory case study we have to do. Magnavision Corporation is expected to grow at higher rate of 4 years. Thereafter, the growth rate will be fall and stabilize at the lower level. The following information is given assemble. They given the revenue 3000, EBIT 500, capital expenditure 350, depreciation 250, net working capital as a percentage 25%, corporate tax for all time 30%, paid up equity capital as per the 10 per value 400, market value of debit is 1200. Next they given the input for the high growth rate period. Length of the growth period. Length of the growth phase is 4 years. Growth rate in the revenue and depreciation, EBIT and depreciation expenditure as 20% they are given. For the growth rate, depreciation, EBIT and capital expenditure for the 4 items they are given the 20%. Next, net working capital as a percentage of revenue they are given the 25%. After that, cost of debit they are given the 13%. Next, debit equity ratio they are given the 1:1 in the ratio. Risk free return is 11%, market risk premium as 7%, equity beta as in 1.129. Next, they are given the stable growth period. In the stable growth period, expected growth in the revenue and EBIT is 10%. Capital expenditure are offset by depreciation. So there is no capital expenditure and depreciation. So there will be nil. Net working capital as a percentage of revenue is 25%. Cost of debit is 12.14. Risk-free rate is 10%. Market risk premium is 6%. Equity beta is 1.0 ratio. 1 point beta. Debit equity ratio is 2.3. What they asked to calculate? What is WACC for high growth pace and the stable growth pace? Second one, what is the value of the firm? So let me calculate the computation of WACC, weighted average cost of capital. Here there is a formula for weighted average cost of capital. Cost of debit they given here. See here they given the cost of debit. In the cost of debit they given the 13%. In the interest we are taking the 13 and 1 minus the tax rate. Tax rate they are already given here. The tax rate all the times is 30%. So we are taking the 30%. So 13 minus 1 minus 30 is 70. So 0 in the percentage there we have to take 0.30. So 1 minus 0.30 is 0.7. 13 into 0.7. 13 into 0.7 is a 9.1% for the high growth period. So we have calculated high growth period. Next, stable growth period. So they are given the cost of debit is an interest. Cost of debit 12.14%. They are given 12.14 into 1 minus tax. Tax all the times as 30%. So 0.30. So we have to calculate 12.14 into 1 minus 0.3 is 0.7. So 12.14 into 0.7 is an 8.49. So 8.49 we can take as 8.5%. After calculating the cost of debit, we should be calculate the cost of equity. The cost of equity formula is RF plus beta into RM minus RF. They are given the RF, risk-free return. Risk-free return for the high growth rate is 11%. 11% is the risk-free plus they given the beta here 1.29 as the beta they are given. 1.129 is the beta and the RM minus RF is the market risk premium. Market risk premium we call as RM minus RF. So the 7%. So what will be the next high growth rate is RF is a risk free return as 10% plus beta they are given the equity beta they are given the 1.0 as 1 or we can take 1.0. RM minus RF is in market risk premium, so they given the 6%, 6. So let me calculate 11 plus 1.129 into 7. Sorry, 1.129 into 7 plus 11. We get the 18.9. 18.9 as the percentage for the cost of equity high growth rate. Next, RF they are given the RM beta they are given 1 into 6. 6 will get plus 10 is an 16. For this one we will get the 10 plus 6 is equals to 16 percentage. So next we have to be calculate the debit and equity for the weight. So they are given in the debit and equity as here. Debit and equity ratio is 1:1 and the stable growth is debit and equity. Here they given 2:3. We have to calculate the weight. 1:1. 1 plus 1 is equals to 2. 1 by 2. 1 by 2 if we calculate means 0.5 we will get, and 2 plus 3 is equals to 5. 2 by 5 plus 3 by 5 we will get 0.4 plus 0.6 is equals to weight is equals to 1. So WACC want to calculate. KD means cost of debit. What we get? 9.1. Weighted average. Weighted debit means here we get it now 0.5 into 0.5 plus weighted debit cost of equity 18.9 into 0.5. Here next we are get here 8.5 into 0.4 plus 8.5 into 0.4 plus 16 into 0.6. So let me calculate this one. 9.1 into 0.5 equals 4.5 plus 18.9 into 0.5 we will get the 9.45. If we add these 4.55 we will get the 14 percentage. So next we get the stable growth calculation. 8.5 into 0.4 we will get the 3.4 plus 16 into 0.6. 16 into 0.6 is equals to 9.6. If we add this one 3.4 we will get the 13 percentage. We got now weighted cost average cost of capital as a WACC 40% and 13%. So we have found it now WACC for high growth phase and the stable growth phase. We have to find the what is the value of the firm. So what is the value of the firm means computation of free cash flow we have to be find. They are given the revenue. This is the formula: revenue EBIT tax on EBIT NOPAT. For the NOPAT we have to be minus EBIT minus tax. The difference we should be find, that is the NOPAT. Already I given the format in the before class. So this year they given the revenue. What is the revenue they given? They were given the 3,000 as the revenue amount. 3,000 we are taken the revenue amount. For the first year what will be the revenue? They asked in the high growth rate from the zero. For the zero year is 3,000. For the first year what will be happen? For the first year the growth rate in revenue want to be take the 20%. So for the 3,000 we add the 20%, we will get the 3,600. 3,600. Again for that only if we add 20% we will get the 4,320. Again we add 20% we will get the 4,320 plus 20% if we add we will get the 5,184. We add 20% again we will get the 6,220.8. Again we add the, so for the fifth year, for 1 to 4 year this is the high growth rate, and for the stable growth rate they are given the percentage as 10%. We should add the 10%. For this 10% we will add, we will get the 6,842.88. So after this let we want to take the EBIT. They are given the EBIT as the 500. On this EBIT they ask for the high growth rate to take the EBIT 20%. For the stable growth they ask the 10%. So let we do for the 4 years 500 plus 20% 600 plus 20% 720 plus 20% 864 plus 20% 1036.8. For the stable growth they given the 10%, so we are adding the 10%, 1140.48. so we have calculated the EBIT. Next what we have to do, tax on EBIT. Tax on EBIT, how to find EBIT? They are given. No, EBIT we already calculated the EBIT. For the EBIT tax, what should we take tax? They are given here the corporate tax. Corporate tax for all the time is 30%. So we should take 500 into 30%. 500 into 30% as 500 into 30%, we will get the 150. So for the 600 we will get the 180. For the 720 we will get the 216. For the 864 we will get 30% is equals to 259.2. For the 1036.8 into 30% we will get the 311.04. For the 1140.48 we will get 30% as 342.14. so we are taking the we have calculated the tax on EBIT. Next we should calculate the NOPAT. NOPAT formula is EBIT minus tax. So 500 minus 150, what we will get? 500 minus 150, if we calculate 350 we will get. So the 350 will be the answer. Next what we want to do? 600 minus 180. 600 minus 180 we will get the 420. So here the 420 for the first year. So for the second year should be take, what should be take? 720 minus 216. 720 minus 216. If we do 504 we will get the answer for the second year. So next 864 minus 259.24. 864 minus 259.2. 259.2 we will get the 604.8. So next for the fourth year 1036.8 minus 311.04. if we do, we will get the 725.76. so for the fifth year 1140.48 minus 1140.48 minus 342. 798.34 we will get for the year 5. So we have calculated the NOPAT 350, 420, 504, 604.8, 725.76, 798.34. We get the NOPAT answer. After NOPAT, we should add the depreciation. We will get the cash. So we should add the depreciation. What the depreciation they are given here? The depreciation they are given the 250. For the first year, what should we take the percentage? 20%, and the fifth year stable growth period is 10%. Sorry, nil. The depreciation they are not given anything. No, so I said in the question only is nil should be taken here. So here they are given the 350 as capital expenditure. Capital expenditure they are given here as 350, and the capital expenditure as 20%, and capital expenditure nothing they are given, so the nil we should be taken. So we are taken here the 0. So the 350 for the first year, what should we take? 20%. For the 20% we should be